This presentation is going to focus on a very unique opportunity for consultants, 1099 employees, independent contractors, physicians, dentists, lawyers, or even small business owners who have just a few employees. It's called a solo defined benefit plan, or a one-person defined benefit plan. Now you might be wondering why would somebody want to do a defined benefit plan? If you look out into the landscape right now of the corporate world, for big corporations, they're all getting rid of their defined benefit plans. The pension plan is almost a thing of the past for most companies. And that's because they're very rigorous. You have people now who are living a very long time relative to what they were. So the cost to companies is huge. And the plans they're not flexible. So most companies, big companies now are going to 401k plans, maybe some profit sharing, and leaving the pension plan in the dust heaps of history. You also have a lot of governments that they still have their pension plans, but they're underfunded so badly that at some point they're going to face the grim reality that they can't continue either. So if the corporate world for big companies and if the government world is starting to face the facts that defined benefit plans just don't work, why would a small business owner or a contractor or a consultant want to think about a defined benefit plan? Doesn't make much sense, right? Well, the reality is for the small business owner, the defined benefit plan is just a fantastic opportunity. So, the way it works again is it's kind of goal-based. You're trying to provide a benefit, a pension when you retire. So maybe if you're making $100,000, you want to have a $100,000 pension when you retire. That's what you focus on. That's your goal. Now, the beauty for the defined benefit plan for small business owners or consultants is the way it functions. So there's really two worlds for retirement plans. There's a defined contribution plan and a defined benefit plan. Now, the defined contribution is, as it sounds, you can contribute a certain amount by law. Doesn't matter if you're 21 years old or 61 years old. It's always the same that you can contribute. Defined benefit, again, it's based on what your pension's going to be when you retire. 100,000, 150, 60,000. Well, the beautiful thing is, in order to have enough assets at retirement for a defined benefit plan, the amount that you can save when you're older goes up substantially. These are actuarial-based plans. That means that an actuary comes in and says, okay, we've got Joe, he's a consultant. He's 62 years old. He's going to retire at 65. He wants to have a pension of $100,000. In order to do that, he needs X amount at age 65. And then you take Keith, who's only 25. Same thing. He wants a $100,000 pension when he hits age 65. So he needs X. Well, obviously, someone who is 61 has a much shorter time frame to save than somebody who's 25. So the amount that you can put in to the defined benefit plan for the 61-year-old is substantially higher than it would be for the 25-year-old because they have a lot less time. And again, it's not contribution-based, it's benefit-based. So they have to fund it enough to get you the amount of assets you need to create that pension. So again, the plan is based on age, your income, and years until retirement. Now, it is capped at $210,000 per year. So that's the maximum pension that you could get. Or I'm sorry, the maximum you can put into the plan each year, compared to $59,000 for defined benefit or defined contribution plan. So, you're looking at it, that 61-year-old might be able to put in $210,000 into the defined benefit plan, as opposed to only being able to put in $59,000 if they did a defined contribution plan. Usually, the retirement age is age 62 or older, but the plan can be amended to change the goal. So whereas a corporate plan at General Motors, General Mills, General Electric, things like that, you really can't amend it all that much. With the defined benefit plan for small businesses, it can be modified more frequently. So let's just take a quick look and get an idea of what does it really mean for you as far as how much you can put away. So what we're looking here is for 2016, a business owner age 52 who's earning $265,000 of W-2 income annually who wants to retire at age 62. So in this case, if that business owner was going to do a simple IRA, they'd be maxed out at about $23,000. For a SEP, they'd be at $53,000. For an individual 401k, again, we'd hit that defined contribution limit of $59,000. But if they wanted to do a defined benefit plan, that person would be able to put in $182,000 just in the defined benefit plan. Now, the beautiful thing is you can also couple a defined benefit plan with a 401k. So that would allow this person, age 52, to put away $222,000 as opposed to the maximum from a defined contribution of $59,000. So if you have ample cash flow, if you don't need it for living expenses, you can really start to sock away a lot of money. And remember, this stuff is all tax deferred, so you're going to get a massive tax break as well, and we'll talk about that in a second. So as I mentioned before, age is the big factor. So these defined benefit plans are ideal for people who are age 45 or older. Over the 50s, even better. But basically, we can start to see some serious savings and benefits if you're 45 or older. So let's just take a look at an example of two doctors. Right, Charles is 52, Tim is 35. Charles wants to retire in 10 years, whereas Tim's got 27 years to retire. They're both making $450K a year. So if you were going to do a defined benefit plan, the contribution for Tim would be $70,600, which is still well above the $59,000 he'd be able to do to a defined contribution plan. But the defined benefit contribution for Charles, who's older, is $182,000. And these amounts, by the time they retire at age 62, should be able to provide an annual benefit of $210,000 per year. So you can see for Tim to get the $210,000 pension, he needs to put $70,000 away, whereas for Charles, who only has 10 years, he's got to really sock it away. So based on actuarial tables, they're coming up with $182,000. So who's an ideal candidate for defined benefit plan? So again, small business owners, if you're, I say 45 or older, it's pretty ideal, especially if you're a 1099 employee or an independent contractor. If you get most of your income from a K-1 or 1099, it's really good for you. The other thing I see a lot of times, if you have one spouse who makes enough to support the household and the other spouse is self-employed, you can sock away a lot of the self-employed spouse's income. But it's also good for regular business owners, physicians, lawyers, if they have 4 or 5 employees, especially if they're the oldest of all the employees. So again, for new plans, you're looking at, ideally you want to have to put away $120,000 per year. If you don't have the cash flow to put away more than $59,000, you're better off just doing a defined contribution plan. But if you have the cash flow and you can put away about $120K a year, this is an ideal opportunity for you. Usually you want to have 8+ years until retirement, but that's not necessary. I've done it with as few as 2 years before. And then again, it can integrate beautifully with a solo 401k plan. The other thing is you select the investments, you and your financial advisor. So it can have anything in it that you want. You can really create your own portfolio. So what is the eligible compensation for these defined benefit plans? So obviously, if you're a C corporation or S corporation, it's going to be your W-2 income. So any kind of distributions from the company, S corp, or distribution or dividends, you can't include that as part of the defined benefit plan. But if you're a sole proprietor, this would be 1099 employees. If you're doing a Schedule C in your tax return, it's basically going to be whatever earned income you have from the profits of the company. If you're doing a partnership, you're gonna get a Schedule K-1, but again, it's going to be your earned income overall. So you don't have to worry so much about distributions or dividends. what are the key dates here? So you got to have the plan established by the end of the year, December 31st. Don't necessarily have to have it funded by then, but you do have to have it established. As far as funding the plan, you do it when your taxes are filed, but it can be no later than 8.5 months after the end of your fiscal year. So you're basically just get things open by December 31st, and then you have until you do your taxes or 8.5 months to actually fund it. And if you are going to fund it during the year, because it can fluctuate depending on how much money you're making, we highly recommend that you only do about 50% of the assets before the year-end income statement. Okay, so I'm just going to give you a quick real-world example here. I did one for a client of mine. She was a coach. She was 61 years old. She was making just over $300,000 a year. Very nice income. But she was just using the SEP IRA. Her CPA really didn't know anything about these defined benefit plans and didn't even have an individual K. It was just a SEP. So she was putting away about $52,000 a year, which is good. So what we did, we came in, we set up a 401k plus a defined benefit plan. And we set it for retirement at age 64. And what ended up happening is she was able to put away $225,000 per year into her combo defined benefit plan of 401k. So there were additional costs. As I've mentioned before, this is actuarial based, so you have to hire an actuary to do the projections. A little bit extra cost. It was about $1,300 per year over what she was paying for her SEP IRA. But she was getting almost $62,000 of tax savings beyond what she was getting with her SEP IRA. So, I mean, think about that for a second. And then even after the extra expenses for the defined benefit plan, she was saving almost $61,000 per year in taxes. Plus, she was building up her retirement savings substantially faster than she would otherwise. So what do you want to do? The big thing is we do this all the time. We'll run a feasibility study for you. Take a look at what your income is, what your cash flow is, and try to tell you how much you could sock away into one of these plans. The other thing is we're very happy to talk to your CPAs so that we can kind of do a collaborative approach to make sure that it's appropriate for your tax situation. I love talking to CPAs because I find so many of them don't know about these defined benefit plans for individual 1099 employees or consultants, or even some small business owners that have only a few employees. It's a great education tool for them as well. But what I do is I work with your CPA and we kind of come up with the plan. Are there any downsides? Well, there's always downsides to everything. So as I've mentioned previously, it does cost a little bit more than you would with a traditional SEP or simple IRA or even an individual 401k. Probably looking between $1,200 to $1,500 per year more. And most of that's due to actuarial costs. So you have to hire, the math nerd to go in and figure out how much do you have to save this year in order to fully fund this plan. It's not quite as flexible. So with a SIMP, SEPL, or 401k, you control the amount that you contribute to the plan. This isn't quite as flexible. There is flexibility. If you have some bad years, you can obviously modify the defined benefit or the pension amount. So if you were planning on a $150,000 pension and you hit some rough times, you can back that down to $100,000. So that will allow you to contribute less. You also might have more in the account, so you don't have to contribute as much. The other thing, it's not very well suited for business owners who have well-compensated older employees. These plans are, if you have employees, these plans are great for you if you're the oldest in the office and you make the most. If you're an owner who has a few employees and they're all 50 or older, this might not be a very good plan for you. But if your support staff is 40 or under and you're 50 or older, you're going to really be able to plow away a lot of money for yourself while still providing something for your employees. So that's basically it. If you have any questions, please feel free to contact me. You can always go to my website, get my email there. While there, you can also sign up for our monthly newsletter. We provide information like this on a monthly basis. You can find this information on our Facebook page, as well as our YouTube page. You can just search for Kirk Kinder, and you'll find it there. So I appreciate you listening. This is a great opportunity for the independent consultant, for the 1099 employee, or the small business employee who's 45 or older. If you have any questions, please let me know.